Welcome to the True P&L Deep Dive. Before we start, a quick disclaimer. This analysis is for educational purposes only and does not constitute financial advice. Always do your own research. Now, let's get into the numbers. We are launching into a critical session today, and our target is the H1 2026 results of LB Finance, or LFIN. Our mission, as always, is to strip away the glossy presentation and the marketing fluff to find the true P&L, the underlying economic reality of the business model.
And this one requires some real focus because LFIN's headline numbers are, quite frankly, intoxicating.
They really are.
If you just look at the surface metrics, management has delivered a spectacular half year. We're talking about a reported 24% net profit jump, pushing the total toward the Rs $6 billion mark. It's Rs $5.8 billion specifically.
Oh, right.
And crucially, their return on equity, the ROE, is sitting at an elite 21.88%. These are, performance metrics that belong on a trophy wall.
Absolutely. The market loves an elite ROE because it signals superior capital efficiency. But as soon as we start stacking the balance sheet metrics against this phenomenal profit, a glaring contradiction appeared. An anomaly so significant that it immediately shifts the focus from celebrating the reward to scrutinizing the risk.
That anomaly, for us, is the entire strategic lens through which this company must be viewed. It dictates their risk profile and, the sustainability of those elite returns.
So what is it?
We're talking about the funding structure, specifically the company's loan-to-deposit ratio, or LDR, which sits at a massive, and I mean massive, 166.8%.
Whoa, okay. Let's spend a moment on that LDR because for listeners who might not track financial institutions daily, that number needs to be translated. What does 166.8% LDR mean in practical terms?
It means the business has committed to lending far more money than it has secured from its most stable core funding source, which is, of course, retail customer deposits.
So for every 100 rupees...
Exactly. For every Rs 100 in deposits that customers put in their savings accounts, LFIN has loaned out Rs 167. They are aggressively leveraging their balance sheet to fund growth.
So if they only have Rs 100 in those stable long-term customer funds, that deficit of R 67 has to come from somewhere else.
Precisely. And the data is unequivocal on this. They are filling that substantial gap primarily with rapid high-volume wholesale borrowing.
Meaning bank borrowings, commercial paper.
Bank borrowings, short-term commercial papers, a real dependency on the debt markets. They are fueling their loan book expansion at a pace nearly 3 times faster than they are building their foundation of stable, sticky deposits. I mean, this isn't a leisurely drive. This is hitting the throttle hard.
And that structural choice is the secret sauce behind that 21.88% ROE, isn't it? Wholesale funding, when it's available and cheap, is often less expensive than maintaining a massive retail deposit network.
That's the calculation. This strategy is brilliant when capital is cheap, liquidity is abundant, and the market is stable. It successfully leverages their equity base and dramatically boosts those profitability metrics.
Yeah.
But the strategic question, the one that frames this entire deep dive and the one you, the serious investor, must answer, is about the trade-off.
Right.
Is this high-octane growth sustainable? Or does this massive LDR of 166.8% expose the company to undue, maybe even existential liquidity risk if the cost of funding suddenly spikes?
Or if those markets just dry up entirely.
Exactly. That LDR is the structural fault line we are analyzing today. We need to see if the other parts of the business are strong enough to withstand the pressure inherent in that choice.
Okay, so let's unpack that first pillar, operational health. We acknowledge the phenomenal 24% net profit growth, that our 5,839.2 million figure. But was this high-quality growth, or was it just achieved by taking on cheap debt and hoping for the best?
Well, when we dissect the revenue components, we immediately see evidence of the funding pressure we just discussed. Let's start with the traditional lending activity. Interest income was up a respectable 19%.
Which makes sense, given the loan book growth.
It's a strong reflection of the 27.6% growth in their overall loan book.
But there's a crucial counterpoint there that reveals the cost of that growth. The interest expense, what they pay to get those funds, jumped even more sharply. It was up 41.6%.
That 41.6% jump in expense is the direct consequence of the 166.8% LDR. It tells us that while the loan book is certainly expanding, the implied net interest margin, the core profitability from lending money, is clearly under substantial pressure.
Because they're paying a rapidly increasing premium for those wholesale funds.
That's it. The high volume of business is masking a margin compression.
So if LFIN was just a pure-play lending house that relied solely on that net interest margin, the profit picture would look significantly weaker, maybe even flat, once you factor in that huge jump in debt costs.
It would. And that is exactly why we need to celebrate the standout performer in their P&L, fee income.
Okay.
This segment didn't just grow. It surged by a phenomenal 66% to hit ours, 3,314.7 million. This is, textbook revenue diversification. It provides a critical cushion.
Let's delve into that surge. A 66% jump in fee income is massive. For a financial institution like this, where does that kind of revenue typically come from? Is it sustainable?
That's the million-dollar question, isn't it? A large portion would come from loan processing fees, documentation fees, maybe some transactional services, but you're right to be skeptical. It could also come from early settlements.
Where borrowers pay off loans ahead of schedule and get hit with a penalty.
Right, which would inflate the current fee income but be non-recurring. However, even if a portion of it is non-recurring, the sheer scale Rs, 3.3 billion, suggests a fundamental strengthening of their ancillary services.
So they're not just relying on the lending spread.
No. They are successfully monetizing the entire client relationship. And when your primary lending margin is squeezed by rising funding costs, having this robust, growing, non-interest revenue source is absolutely vital. It stabilizes earnings.
So the overall profitability is being rescued, in a sense, by the success of their fee-generating operations. This tells us the operational machine isn't just scaling, it's evolving. Now, let's look at the efficiency of that machine. How disciplined is LFIN?
This is where LFIN provides concrete evidence that they are not just growing, but managing their expenses with best-in-class discipline. We zero in on the cost-to-income ratio.
The CI ratio. This tells us how much money they have to burn just to generate Rs 100 in revenue. What's the number?
The CI ratio dropped significantly to 31.1%, down from 33.7% last year. That 2.6 percentage point drop is meaningful at this scale.
And 31.1% in the context of the industry is.
It's excellent. Hitting the low 30s in financial services is notoriously difficult. Many established players hover in the high 30s or even low 40s.
So to maintain that while growing the loan book by almost 28% suggests exceptional managerial control.
It implies successful operational leverage. For every Rs 100 they earned, only Rs 31 was spent on operations, salaries, rent, IT, everything. This indicates management is successfully migrating costs, maybe through digitalization, allowing that new income to drop to the bottom line.
So, to summarize this section, the engine is highly efficient. It's evolving its fuel source with that fee income growth. This confirms the headline profit jump is high quality from an operational standpoint, even if the core interest margin is under pressure. But execution can't always hide risk. We have to turn to asset quality.
Right. And now we pivot to the risks inherent in generating that profit, specifically asset quality. When an institution grows its loan book by 27.6% in 6 months, you'd naturally expect underwriting standards to slip a little.
You expect some deterioration, yeah. Rapid expansion and quality control often work against each other.
But LFIM presents metrics that are, as you said earlier, frankly, suspiciously pristine. Their gross non-performing loan ratio stands at 1.55%.
Which is a huge drop from 2.86% last year. For a high-growth NBFI in this market, 1.55% is truly industry-leading.
It is. It's a testament to strong initial underwriting and active portfolio management. However, the true deep dive, the most compelling anomaly in their entire financial statement, comes when you look at the net NPL ratio. This figure is not just low, it is highly unusual. It's sitting at negative 1.36%.
Wait a minute, a negative NPL ratio. I need to double-check my notes on that. That is the kind of metric that forces analysts to pull out the accounting manuals because statistically, this shouldn't happen.
Exactly. It means something very intentional is going on with their provisioning.
So let's clarify that distinction. Gross NPL is the total pool of bad loans. Net NPL is.
Is that gross NPL number minus the total loan loss provisions the company has set aside. So when the net NPL is negative, it means the company has set aside more money in provisions for losses it thinks might happen than the actual value of non-performing loans it currently holds.
They're provisioned beyond 100% coverage.
Way beyond. It sounds less like standard prudence and more like hypervigilance. It's the ultimate financial hedging strategy.
Let's use an analogy.
Okay. If you own a fleet of trucks worth Rs 100 million, a standard insurance policy might cover the Rs 100 million. LFIN is essentially insuring those trucks for Rs 101.36 million. They are dramatically overinsured against the current known reality. We're talking about aggressive prudence.
But let's play the skeptic. This conservative philosophy comes at a cost, right? Provisions are charges against the P&L. They're sacrificing short-term reported profits today. Couldn't a skeptical investor argue this is a form of earnings smoothing?
That is a very valid intellectual critique, and it's one serious analysts have to consider. By creating this massive buffer, they ensure that if a wave of NPLs hits next year, the required impairment charge is dramatically smaller. It helps them smooth sail the P&L.
Right, it makes future profits look artificially stable.
It could. However, the sources suggest the interpretation leans more towards defensive positioning, mainly because of the context of their high-risk funding model. The strategic advantage of this huge provision buffer is undeniable. It signals stability over short-term profit maximization.
They're saying, we have already taken the anticipated pain for loans that haven't even gone bad yet.
That's precisely. And the sources describe this buffer as a moat during downturns. If that wholesale funding risk we identified suddenly materializes, they will be better equipped to withstand the shock because they have this ready-made reserve. They won't need to suddenly book massive, debilitating impairment charges.
So it becomes a competitive advantage. If their peers are struggling, LFIN can tap into this buffer. It gives them flexibility, maybe even the confidence to acquire distressed assets when competitors are paralyzed.
Absolutely. The conservative accounting isn't a footnote. It's a core element of their defensive strategy. It tells us management is acutely focused on long-term stability, maybe even subtly acknowledging future market stress that the rosy 1.55% gross NPL isn't capturing. They're building a financial bunker while the sun is shining.
Okay, we've established they're efficient and aggressively conservative. Now we move to a section that separates the casual observer from the truly discerning investor, the quality check of the reported earnings. They reported a fantastic Rs. 5.8 billion in accounting profit. Is it real?
This is often the investor blind spot.
Where?
People see net profit and assume that's money in the vault, but net profit is an accrual measure. Smart investors prioritize operating cash flow, which answers one simple question. Did the company actually collect the money it said it earned?
Cash flow cuts through all the complexity. If you see high profits but low cash flow, it often suggests they're recognizing revenue on paper but failing to collect the actual cash. It's a huge red flag.
And historically, that divergence between profit and cash often warrants extreme scrutiny in this sector. But LFIN delivers an exceptionally strong metric here. The reality is reversed from the typical cautionary tale.
What are the figures?
Okay, so they reported a net profit of Rs. 5,839.2 million. But their adjusted operating cash flow, the actual deployable cash from core operations, was substantially higher, at a staggering Rs. 7,122.5 million.
That's a huge difference. Over ₹1 billion more in actual cash generated than what they recognize as accounting profit. That immediately negates any suspicion of poor collections.
It leads us directly to the cash conversion ratio, or CCR. We calculate this by dividing the adjusted operating cash flow by the net profit. LFIN's CCR is 1.22. This is the gold standard.
Let's put 1.22 in context. Most healthy companies aim for a CCR of 1.0, right? 1 rupee of profit backed by 1 rupee of cash.
Exactly. Many companies, especially those growing aggressively, struggle to hit 0.8 consistently. When we see a CCR consistently below 0.8, it's a warning sign. It signals earnings are potentially synthetic.
But LFIN is far on the opposite side of the spectrum.
Far on the other side. A CCR of 1.22 means that for every rupee of profit they booked, they actually generated Rs. 1.22 of usable cash. This implies their reported earnings are of exceptionally high quality.
I think we need to delve into how a high-growth lender achieves this. It's not magic.
It's not. It signals multiple things. First, incredibly efficient collection processes. Second, low reliance on non-cash assets. But third, and this is key, the high cash conversion is often bolstered by their provisioning philosophy.
So it connects back.
It connects directly back. The provisions they booked, which reduce the net profit figure, are non-cash charges. By aggressively increasing provisions, which hits the P&L but does not require a cash outlay, they artificially lower the denominator, net profit, which pushes that CCR ratio higher.
So the negative NPL anomaly and the gold standard CCR are two sides of the same conservative coin.
That's a perfect way to put it.
That's a fascinating insight. The very conservatism that raises skeptical questions is simultaneously boosting the earnings quality metric, reassuring investors their profit is real. So the report card on operational quality is phenomenal. But we must pivot back to that structural fault line, the balance sheet risk.
We have to. We must return to the core strategic risk, because this risk can negate all the quality metrics we just discussed if the market environment shifts. We're back to that 166.8% LDR.
Let's put some hard numbers on that growth mismatch over the H1 period. The loan book grew by a massive 27.6% to reach Rs. 254.2 billion. relentless momentum.
Conversely, their stable retail deposit growth lagged far behind. It only increased by 9.8% to ours, 152.4 billion.
So loans growing nearly 3 times faster than stable deposits. They're funding a marathon using sprint reserves.
And this math demands attention. In the first half alone, LFIN issued ours 54.9 billion in new loans. To fund that, they needed ours 60.4 billion in new funding overall. The question is, where did that ours 60.4 billion come from?
Not from deposits.
Not primarily. The critical detail is that these new funds were raised mostly wholesale. Their reliance on bank borrowings in the debt markets increased by a staggering Rs, 46.8 billion in H1 alone. This is a deliberate, massive strategy.
This is the double-edged sword of high finance. In a liquid, low-rate environment, it prints money. But when the tide goes out,
The dynamic reverses instantly and dangerously. We have to ground this in recent history. The source material warns about regional volatility. Think about the liquidity crises faced by MBFIs around 2022. Wholesale-dependent institutions were hit first and hardest.
what exactly happens in that scenario?
The cost of rolling over that massive debt spikes. That Rs 46.8 billion in new funding is often short to medium term. When those instruments mature, if market rates have spiked, or if the market just closes due to panic, which happened in 2022, the institution is faced with either paying crippling rates or defaulting.
That 41.6% jump in interest expense we saw earlier would look tame by comparison.
Tame. A true funding crisis could wipe out all their gains. So, LFIN is executing a high-risk, high-reward strategy. The only true firewall against this risk is capital.
So let's check the buffers. How well are they capitalized to withstand a shock?
Structurally, their current capital position remains strong. This is their key saving grace. Their Tier 1 capital ratio is 22.74%, far above the 10% minimum. Total capital is at 23.66%, also well above the 14% minimum. On an absolute level, they have plenty of cushion today.
But the critical concern isn't the current level, it's the velocity of change, it's the trend.
Precisely. We need to look at the trend. Capital ratios are compressing rapidly. Last year, Tier 1 was 27.83%, and total capital was 28.64%. That represents a drop of about 5 percentage points in just 6 months.
That rapid loan growth is burning through capital.
It is consuming capital like fuel in a rocket. Every new loan they issue requires them to allocate a portion of their capital as a buffer. Since the loan book grew 27.6% in 6 months, they've been burning through that buffer extremely quickly.
So they're still very well capitalized, which is excellent. But if they maintain this aggressive growth rate, the compression will continue, making that wholesale funding risk even more pronounced over time. The firewall is shrinking.
The speed of compression introduces an extra layer of risk. However, on the positive side, this aggressive growth is translating into underlying value. Net asset value per share still increased by 6.9% during this period to 99.53. So the ratios are compressing, but the underlying book value for the shareholder is still improving.
Okay, when we look at the P&L and the high-level balance sheet, it's tempting to treat the company as one monolithic entity. But we need to know exactly where the profit is actually being generated. The segmental data.
Absolutely. The segmental reality is definitive, and it's a part of the report many investors skip. While LFIN has a history in multiple services, the company today is fundamentally a loans business, period. Everything else is a supporting act.
Break down the portfolio to prove that point. Where's the money?
Loans and advances completely dominate the asset structure. They represent 72.8% of total assets. That's a massive Rs, 223.9 billion. This segment is also the primary profit engine, contributing 70% of total profit.
And it's the part that's growing fastest.
By a remarkable 31.7% in the half year. This is the rocket fueling everything we've talked about. Now compare that to their legacy business, leasing.
Okay.
Leasing is only 12.4% of assets. It contributes 24.6% of the profit, so it's still profitable. But the growth is subdued, only plus 5.2%. They've clearly shifted focus.
And the international business is tiny.
Less than 1% contribution. It's immaterial to the overall thesis right now. The whole story hinges on the success of that loans and advances segment.
So that brings us back to credit quality, but specific to these segments. Does the low NPL hold up across both?
The segmental credit data is really interesting. The leasing portfolio, the older, slower-growing business, actually showed an impairment reversal of Rs 193 million.
A reversal. So they're collecting on old bad debts.
Yes. It suggests the portfolio is actively improving in health. It's a very stable, low-risk floor for the business.
However, the loans segment, the one that grew 31.7% and contributes 70% of the profit, is exactly where the primary credit costs were incurred. It recorded an impairment charge of Rs 626 million.
And that's predictable and healthy. You have a tale of two segments. the slow, stable leasing business cleaning up its books, and the explosive loans and advances business driving profit and incurring all the new credit risk.
So that leads us to the one-liner takeaway for you, the investor. Your investment in LFIN is fundamentally a bet on management's ability to successfully underwrite and manage that massive R's, 223.9 billion loans and advances portfolio. Everything else flows from that. If that growth starts to sour, the entire thesis unravels quickly.
So let's synthesize the dual nature of this business one final time. We have two starkly contrasting narratives. The elite performance of the P&L versus the aggressive structural risk of the balance sheet.
The reward versus the risk.
On the reward side, the operational and earnings quality is exceptional. You have the ROE at 21.88%, a high ROA at 4.24%, that industry-leading gross NPL of 1.55%, a best-in-class CI ratio of 31.1%.
And that gold standard cash conversion ratio of 1.22.
Exactly. The quality of their operational execution and earnings is proven.
But the structural risks are equally undeniable. That aggressive 166.8% LDR, the dependence on over R's $46 billion in new, price-sensitive wholesale funding in just 6 months, and the rapid compression of their capital ratios.
Which brings us back to the core strategic question for you, the listener, to continuously track. Can the business maintain affordable funding access given this breakneck pace of growth?
If the market remains liquid and rates stabilize, this high-leverage model continues to print money. But we must be clear, having revisited the lessons of 2022. If the debt market tightens, this specific funding structure is the first to feel the squeeze.
The concentration of risk lies entirely in their funding source and the velocity of their loan growth. And that aggressive strategy necessitates the defense mechanism we found earlier, that highly unusual negative 1.36% net NPL ratio.
And that links the entire deep dive together. While this ultra-conservative provisioning is incredibly defensive today, we have to view it through the lens of their aggressive funding. We have to ask, is this level of provisioning, is it management's silent acknowledgement?
Is management acutely aware of the wholesale funding risk, using this heavy provision as an internal fire suppression system? In other words, is the massive provisioning their way of internally preparing and accounting for the potential unavoidable costs of operating with a 166.8% LDR?
So the anomaly is actually the answer to the risk.
It might be. It ties the structural balance sheet risk directly back to the asset quality anomaly, suggesting management might be anticipating the price of their own aggression. That is a critical strategic paradox for LFIN, and it's something to keep in your notes as you track the next quarter's funding costs.